Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Popular strategies in a rising volatility environment, which I think actually is forthcoming in the coming months. Buying straddles and selling straddles. I'll focus on these two right now. And when I say buying a straddle, I'm talking about buying a call and a put at the same strike price for the same month. And so if I was to look at something like that, I can go ahead and take a peek at and implement a straddle on the euro. I can be long the EUI puts, or I could be and conversely at the same time concurrently be long the EUI calls as well. Right now, I think that the time behind that, there is a lot of value out there in buying the EUI puts and buying the EUI calls. I think it's all about exposure and allocation. I think if you can allocate 2 to 3% of your risk budget along with properly delta hedging. By delta hedging, I mean that you're not just long the straddle and then you hold it till expiration, but you're long the straddle and you actively manage that position. And I've published a couple of articles on dynamically delta hedging, portfolio risk, and also gamma scalping FX options. And so if you guys email me for that, I can send you the links to that right there. As I've written a couple of those articles over the last few years, which discuss, if you were to get long, the straddle here, and then the underlying spot were to rally up 200 or 300 pips, to a key resistance point, we can go ahead and spot that in. Dr. Hope, I'll go ahead and post that at the end of the discussion here. That's my little teaser to keep you waiting. And we can, in that regard, keep that out there and run it accordingly. So, taking a quick look at some of the software I use. I talked earlier about CQG. Because I'm a pretty focused and intense derivatives trader, I work off of CQG, off of Bloomberg, and off of Trading Technologies, X-Trader. But for my analytics, I use a lot of CQG and some Bloomberg as well. The screen layout on CQG, just very cut and dry. The term structure here we can see from looking at the euro over the weekend. There's 27 days until the current expiration. Implied vol sitting about 10.5%. So if I were to buy a 134.5 call, 134.5 put, it'd be about 308 ticks to put this position on. As you can see, my max theoretical loss about that would be around just shy of $4,000 for a 1-in-1. That's my max risk over the next 27 days. But if you're long the straddle into the weekend, the big news happens. You can step in and fade some of this move and watch your delta adjust accordingly. So going into the weekend, we're sitting at 134.50 on the on this position here. And so as we got into the weekend, that position, we went from 134.50 to 136.50. Our delta went on that trade probably from being delta neutral to probably being long, long 30 tenths or long 30% of an underline or long 25% of an underline. So let's say if I was long 10 contracts, okay, I can then get short 3 or 2.5 of the underline to go back to being delta neutral again. As it turned out, they faded that move over the weekend a little bit, gave back some of those profits, and that helps you pay some of that rent with everything else being equal. So when I talk about delta hedging, I mean you're maneuvering around a position, you've defined your risk limit with this $4,000 initial position, and I'll let Steve comment in terms of some of the machinations that go to some of the machinations that take place. And you can email him at smeisinger, that's SMEIZINGER at ISE.com, and Steve will go ahead and give that over the at the end of this presentation again. But again, this is just some basic ideas in terms of how to set that up. I'm going to throw out a more of a complex scenario here. And then I really want to open the panel up because there's a lot of questions I see stacking up to that right there. And so putting together a portfolio, this is what I'm building right now, and this is something that I think that you may want to consider as well. And if not this position itself, at least the thought process that goes behind it. And that is I'm building a long volatility position in terms of long British pound, long euro, long Swiss franc, that's CHF, GBP, EUR, and CHF, going short volatility on CAD, Aussie, and in Japanese yen, and so if there is some risk out there, I'm hoping to mitigate some of my Vega exposure both on the long side of it and on the short side of it as well. And so you can short a straddle on a basket of CAD, Aussie, Japanese yen. I'm going to go long a straddle on a basket of Euro, GBP, and CHF, and I can do all of that using the ISE options to make that possible. Now, if you have an equity account, I'm also looking to be long a straddle on gold and silver because for the scenario that Fotis talked about, I think that CAD and Aussie can be a little more insulated in that regard. I think the positive carry of Aussie is going to keep Aussie in more of a range, and I think some of the and CAD could pull back as well. I mean, I realize some of the risk that's there. Without going over every single component of every one of these currency crosses, though, in general, I think we're going to see more volatility across the European currency complex than we are in some of the other G10 currencies out there. And so in that regard, I also think that if what Fotis talks about plays out, and I think implied vol is cheap on gold now anyway, but I think if we get a lot of loss of faith in the currencies in the sovereign debt spreads out there in terms of what debt really exists, I think there's going to be a massive flight to gold and into silver as well, and being long volatility on that can set it very nicely. If there's not, however, if the deflationary component sets in, and this is what I learned from being actually long gold in the fall of 2008, is that at least I was long a call spread or long the premium. That I actually benefited from that because I can delta hedge around it and didn't lose anywhere near as much. But if we do get major deflationary concerns that pop in the market, it wouldn't be unprecedented to see gold shave 200, 250 bucks, 25% over the course of 4 to 6 weeks. There's a number of times in the last 5 years where that precedent's taken place. It wasn't just in the crisis of 2008. I think that there's a really great way to maneuver around those positions. And then lastly, I think that I'm going to be short a bear call spread on crude because I think that irrespective of what ultimately plays out, I think crude's in some trouble. I think that the supply glut that exists out there and some of the technical topping patterns which I've seen, coupled with the rest of this portfolio, not only standalone by itself, but coupled with the rest of this portfolio, I think that's a nice blend in terms of how this can all play out. And so just kind of discussing this again, long volatility on long a basket of straddles on the British pound, euro, and Swiss franc, short a basket of straddles on CAD, Aussie, and Japanese yen, going short a bear call spread and a bull put spread on crude because I think that again it's a little bit toppy in here, but it can definitely trade within a range. And then this combination, I believe, and I'm very confident, build a unique volatility exposure that a trader can delta hedge around accordingly. Which again, I encourage you guys to check out some of those articles which I've produced. Now, onto the real stuff. I have a spread trading webinar going on next Tuesday at 9 a.m. Eastern Time. I will be trading live with my own money in real time for all to see, win, lose, or draw. Recommend you guys go to my website. That's osoktrading.com to sign up. You must sign up by Sunday. It is free registration, but if you do not sign up by Sunday for Tuesday's event, you will not be able to get in. Also doing a live, for those of you Chicago natives, I'll be in Chicago from May 9th to May 15th. I'll be putting on a live trading event at that point in time as well for a full day, which I'm very excited about. I love the interaction. It's only limited to 25 people, so I'll encourage you to take a look at that. But you have access to me, and normally one day of mentorship sitting next to me, which I only do a handful of times each year, costs about $5,000 a day, depending on your respective circumstance, sometimes more. And so I do a lot of consulting with emerging managers for proprietary professional traders out there. I've worked with a lot of guys who are looking to make the next step professionally. If that's your interest, that's truly my passion, is along with the markets, helping traders who are serious about this grow. It's how Fotis and I came into being, helping each other develop professionally and helping him grow his business as well. And just has blossomed into a great relationship. And so I encourage you guys. J Netto at osoktrading.com is the best way to get a hold of me, and go from there.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.